business restructuring. I think this is one of those perennials, hey, Caryn. It's the one
Yep.
that no one ever thinks they need until they need it, and then suddenly it's a big problem.
And the number of times that we called in to consult, I think it's almost weekly.
Yeah.
So people start to play in that ground, and that they start going down the path, and then they realize halfway, but by the time they get to the first corner, they go, whoops, maybe we need some help here. Maybe this isn't quite what we thought it was, or maybe, okay, we kind of understand it, but it's a little bit more complicated than we thought.
Yes.
And that's where we sort of put up our hands and say, okay, can we have a chat now?
I think there's a lot of really nice options in this as well. So I also think sometimes people run away from it when they don't need to, just because it's unknown, if that helps.
The one thing that I've learned, and I was looking at when we were doing the slides, we've been doing this for like 7 years. It's like time goes so quickly when you're having fun. But people, and it's the one section that I've sat and listened to you gone, tax people generally get a bit scared of. People get, it's always doom and gloom and he's taking our money from us. But this is one section where he's actually giving you gifts. And it's sort of like a hidden little gem that people don't get. So that's also why I'm putting you up first.
For once.
I sent Carmen an email to say, by the way, in this month's Tech Talk, you starting. But yeah, so, and just for everybody to know, the slides are coming. We've had a little bit of a technical issue with laptops that have been serviced and miscommunications between people. We're currently sorting it out, and as soon as I can get it up and ready for you, it will be available. So we are literally moments away from getting the slides up and running.
In the meantime,
if you just bear with us.
Yeah. So I think this is one of those sessions where I think also, interestingly enough, well, not interestingly enough, but appropriately enough is maybe a better word. Caryn, I was actually sitting in an Examco meeting yesterday talking about integrated questions with accounting and tax for students who are doing their articles and for the qualifying exams. And the one thing that's come across really strongly...
The slides are up. Sorry, can you see the slides on your side?
Yeah, so I've put up my slides.
Okay.
So I'm presenting.
Okay, I have converted the.
There they are.
Okay, yeah. Okay, so they are uploaded. They're uploaded to wherever they need to be for the members. It's all done on our side. Okay.
Yeah. So where I was getting to with this is the one thing that I realized is we tend to have comfort zones. So we tend to become comfortable with thinking of things with an accounting hat or thinking of things in a tax context. And as a result, when we're unsure of something, we then tend to default to, well, tax would treat it like X, so therefore I need to do that way, even though it may be a fundamentally different philosophy in accounting, for example, and or vice versa. And that's one of the big reasons we started these 360s, is because we realized just how easy it also is to get into that default setting of, oh, well, this is the way it logically must work, therefore, or I understand it to work this way in one context, therefore it must work in the other. And I think corporate rules is one of those where, because the tax is often such a big part of the planning, people also then almost, usually it's the accounting pulls the tax behind it. This is one of those where I think the tax sometimes, because we get so hung up on it, almost people presume that then follows through to the accounting, when that's absolutely not the case. Because this is one of these where yours is actually, well, you do you, Carmen, and I'll just come back and do it the same way, whatever it is you've done.
I always think of myself, whenever you start talking about this with a client, to go, okay, well, I'm the broom and the sweep. I come up at the back and I clean up. But you're exactly right. With accounting and law, it's usually they're the horse to you, the trailer. They're the tractor to the trailer. They're supposed to drive the transaction, and you're supposed to respond. Okay, so you've done this. This is the commercial sense of the transaction, and this is the tax consequence of what you've done. Not that people do it that way. They usually try and put literally the trailer in front of the tractor. But yeah, so this is one time where I do think the way that you structure it. So the idea is you want to do a corporate restructure. You want to do a business restructure. And you've got a smorgasbord of options and ways to do it that are beneficial. And you've got to choose, are you going for the brie or the camembert or the cheddar, as to how you're going to do this. And once you're done, I'll just respond to that. But there is that. But the first decision is we want to achieve this different look afterwards. So you've got to have the commercial sense to begin with. It's not a case of doing this just for the sake of doing it.
Yeah. And I think that's possibly, and I realized we didn't actually do our formal intro. We were worrying about the slides. But I think before we do that, the main point of what you'll see today is that the common thread in this is going to be you have toolboxes. There's an entire
Yeah.
toolbox available to you to get to your end goal. But if you don't understand what your end goal is, then you're going to have a very difficult time getting through there. And then it's also just making sure that you understand the consequences of each of those different steps in those toolboxes. And then it's assimilating about it. So it's big picture first, look at what the big picture principles are, and then translating that to planning.
It's almost in my mind like saying, okay, well, you want an outdoor living area to your house. Well, you could, build a patio, you could do a fire pit, you could do all these sorts of things. Which one is it that you want? What will achieve your goals? And what is the most efficient way to do it? And the most cost-effective way to do it. And on my side, what is the least administratively burdensome way to do it? Because some of the ways you go about this are a little bit more straightforward than others.
Yeah. Maybe they're also then cost benefit to me, because sometimes the more burdensome way up front gives you a better answer down the line. So that's also, Anyway, but by the way, so formal introduction for those of you who haven't been with us before.
Honestly, especially a tech talk.
Yes. First thing is, please, we really encourage this. We want this to be an interactive session. We really, these are not meant to be dull, dry. Although Caryn and I can talk to each other like, really, that's not a problem. And we can keep the conversation going ourselves, but we really want you to come and give us your scenarios or your questions or your issues that you have. And it is meant to be an interactive session. And the idea is, as you'll see from both of our bios, which are available in the notes, that Caryn really focuses on the IFRS and the compliance and legal aspects, and I focus more on the tax aspects of issues. But that across the board, what we're trying to achieve with this is almost like a holistic view of how do I address an issue. And that does mean that in 3 hours, we're not going to be able to address every single nuance. It's just not going to happen. But what we're hoping to leave you with at the end of the session is a comprehensive understanding of, well, these are what my options are. These are the big picture principles that we should consider. And here's some of the options that are available to me in order for me to get from point A to point B.
Yeah.
So,
and just for those of that, I did a company secretarial session yesterday, and I sort of said the same thing that we're going to say today. If you see the slide pack, and I did look at it when I was sending it through yesterday, I was like, oh my word. It is very extensive. There's a lot of detail in the slides, but we tend to do that, both of us as presenters. We won't necessarily talk to every single page, but you've got it there for reference later.
Yeah.
So don't stress and think, oh my hat, how are they going to, they're such chatty Cathy's here, how they're going to get through all of this. It's also, we'll talk about things, and just know that you will have the reference in the notes somewhere, even if we haven't gone to the particular slide and said, hey, look here, it is there.
And I think this is also from both of our points of view. The reason we also try and put a bit more detail in the slides is because we also are firm believers in the idea that sometimes half the issue is knowing where to look. Yeah. And at least by providing you with the references and the exact section references, or the appropriate IFRS reference, or the rest, it gives you a starting point of where to go and find some additional information.
We want you to hear our voices in your head for the reasoning and for the thought process, and then you can color in the detail as you go along.
So the section that actually started us all off on this, Caryn's become almost to start thinking of section 42s as a curse word.
Well, it's like the kickoff to the game.
So at this point, I suppose the question is why are you here? So in this poll, there's no right or wrong on this. I'm just interested in hearing your views on it. Is what do you think of the corporate rules from the tax point of view? You're obviously here, so there must be an interest. So point 4 is there as the default option, especially because they changed the tax practitioner rules on CPD.
And you can answer just A, B, C, or D if you're not wanting to write the
Yeah.
whole thing out. So if you just want to say A, B, or C, and remember, people, that Carmen and I see your full names. The rest of the audience don't. They'll just see your initials with the way the system is set up. So you can be quite anonymous in how you apply this. Seeing some practical answers.
Yeah. And honestly, the option here that we've got about one of the options that came through is B, is about Section 42s and the fact that they're becoming so prevalent. I mean, it really is something where I remember when I was, so look, and admittedly, this is starting to come very long ago. It's quite sad. But anywho, I remember when I was at university, the answer was very much corporate rules. It's for listed companies. It does not apply in the SME space. It's literally something that your big listeds do, and everyone else can kind of just walk away from it. Whereas, I mean, Caryn and I operate predominantly in the SME space, and this really
with
is
SMPs.
Yeah.
So we work with small to medium practitioners in the small to medium entity space.
And it really is something which is coming across. Hell, even my uncle, who's a farmer, who insists on he runs a little dairy operation, is starting to talk about Section 42s. Then and it has become mainstream. And I think I think this is something that we also have to acknowledge, is the fact that the world has changed. That we are on a point where there are so many real practical applications where this is actually really useful for us, that we have to come to grips to it. And I think it is also finally starting to, people are seeing the benefits thereof. So I'm hoping that after today's session, you at least will have a starting point in the conversation and be able to appreciate what the options are and what your toolbox is. And I think this is really something that, sorry, I'll get to you now, Caryn, is something that I want to emphasize, is that honestly, what you'll see from the tax side of this is that the tax side is very much about creating a toolbox. There is no right or wrong for your particular transaction. It's just a case of, so you'll see that there are some standard structures that people put together, but your circumstances may be different. So you can put it together in a different way. This is literally like, do I need a wrench or do I need a hammer? And you might need both for a job.
And I was going to say exactly that. You might need a glue gun, or are you going to use screws or glue gun? Depends on how strong you need the system to be, and what you're actually dealing with. And also, what I've learned listening to Carmen, because those of you that know me know that I always joke and say the last time I studied tax was in the last millennium, the last century, and about 3 decades ago, is that it really is that you don't just look at one of these sections necessarily, although one section might be all you need. You might actually put 2 or 3 of them together in a timing sort of situation to get the maximum impact. And I'm seeing here the responses. Quite a few are literally sitting with us on your desk right now. And we're going to give you sort of the oversight and the Kentucky tour of this in 3 hours. But also know that you can also reach out to Carmen and I. We do consult on this, and we can hold your hand if you're needing it going forward. But anyway.
But it's surprisingly easier than you think once you've got the base principles down. All right. So generally, the main things to remember that from a tax point of view, and this is one of the really big disconnects between the accounting and the tax as a starting point. And actually, this is also where the entrepreneur really disconnects from the tax, is because the entrepreneur looks at, this is all my domain, this is all my stuff. Whereas,
this is my kingdom.
Yeah. Whereas tax goes and says different legal entities, different taxpayers. We do not do group accounting under South African tax law. It doesn't exist.
And also from the Companies Act, you are looking at each individual entity from a Companies Act perspective. So you've got to be very careful about not abusing the juristic personality and keeping ring fencing each company as it is, but accounting does see the economic group. And the reason I make that point is that you've got to make sure the decision making and the authorities of each of these things is tracked. So make sure your director resolutions and shareholder resolutions and all the rest are happening in each individual company. Don't go to my economic space as an accountant and say, well, the group has approved to do this. No, well, the subsidiary has to approve to do this, or the holding company needs to approve to do this, from a Companies Act perspective. So the Companies Act, although it acknowledges a group of companies, leans into the tax to say that it's a separate legal entity and protect the juristic personality.
Yeah.
Sorry, just to...
And no, and it adds to that because ultimately, because each of these are separate legal entities, there will be different risk profiles, there will be
Yeah.
different stakeholders, there would be different, and even if they have the same shareholders, the creditors would be different. The people
Yeah.
who work for them would be different, which is why the Companies Act in part also goes and says you have to
Yeah.
consider them separately from the group.
The stakeholders of each individual company.
Yeah. And the tax just goes and says generally our tax principles are as soon as something moves from a taxpayer to another taxpayer, you're going to have tax consequences. That's kind of one of those blanket rules of thumb that, well, actually, it's an international tax principle. It's almost foundational, as it were. And I think this is something which we also need to clarify straight up front. One of the biggest problems that Caryn and I have run across when we start doing business restructures is actually who owns what and what is part of the transaction.
Sorry, I was
And
waiting for that one.
yeah, and it sounds asinine because, well, of course I own it, but when
Yeah.
we're having to split it out into no, you've got 5 companies and you're wanting
Yeah.
to move like this loan and that business between here, there, and you just go, well, I can just mix it up between them. I'm like, no, they're 5 different legal entities.
Yeah.
You
I
are
mean,
you? Yeah,
I was just going to say, first off, we've had people try and sell land or immovable property that doesn't belong to the entity or the person they think it belongs to. And then we've had group restructures where they've tried to settle this restructure with a loan that doesn't belong to either of the entities that are under consideration, but it's a loan within the group. And it gets, because people just, they drop the walls in their heads. There is a loan in the group. There is this property in the group, and they sometimes just don't pay attention to the fine print.
yeah. And it's that which I think is almost the prep work in this transaction, is because also if you are dealing in the SME, SMP space, people will think of it as a global unit.
Yeah.
And it's our job, if we're wanting to structure these properly, is to then go and say, hang on, but I actually have to put the transactions through correctly in each separate legal entity. And now your clients may be great. maybe we've just, yeah, look, we also do see the outliers. So there is that. But
The 5-car pile up on a Friday afternoon.
but properly identifying what the end goal is really, honestly, it's like with anything where the standard argument of plan properly and you'll cut your work in half. With restructuring, that is critical.
Measure twice and cut once.
Yes, because where we've seen this go most wrong is when people didn't actually consider who actually owned what and what the actual end goal of it needed to be, right? One of the other big things which then also comes into this is that there are different definitions for tax, accounting, and practical when it comes to things like group companies. Tax has a very rigid, very narrow definition. Accounting goes even broader than that. And if you then start going into sort of your owner's space, they then just look at, well, everything I own as a pool.
I'd almost say there's a sliding scale. Tax is the most narrow definition. Companies Act is a classic definition, and accounting is just weird.
All right. So I think also then one of the concerns that we get is that because as we move from one entity to another. So if I, for example, to take the very simplest structure, I own 2 PTYs in my personal capacity. And I want to move land that is in company A to company B. Now, if I look at me as an individual, I'm not going to become any wealthier by moving the land from one to the other. I'm literally reshuffling my deck chairs. That's all I'm doing. I'm reshuffling what I've got. I'm just changing who the legal owner is. So in terms of my wealth, it does nothing. But if we go and look at the two individual taxpayers, there's a very big change in wealth in the two individual taxpayers. So, what our corporate rules are trying to achieve is that they are trying to achieve a concession's the wrong word, but it really is. It's to recognize the fact that we don't want to change our foundational principle that when a taxpayer is impoverished or enriched, that there should be tax consequences. But we also concede that there are circumstances where it's not a true enrichment in very big scare quotes. It's literally just reshuffling what you've got in order to make operational or commercial sense. Because it may mean you may be able to finance it cheaper in the one property. You may want to sell the one part of the business without the land or whatever. You can have 100 different reasons why you want to do it. And you shouldn't have to change your commercial rationale just because there's adverse tax consequences because of how you originally set up your structure. And that's really what the toolbox of corporate rules is trying to achieve. We are never going to get to group accounting. That's been made abundantly clear. So this toolbox is what we're going to have. Yeah, I don't know if there's anything you want to add to that.
No, just the other side of it as well is that you've got to also be aware of the impact of these transactions. So a couple of, talking about the 5-car pile up on a Friday afternoon, Carmen and I deal with the stuff that doesn't work, and then we're often called in to clean up and to help them untangle the string that they got tangled up. So part of our our objective of today is to start as you mean to continue and set it up correctly so that you don't have to call us in to untangle it later. Is that, often people, for example, in the Companies Act, for a lot of this, there's often going to be things like a fundamental transaction, because if you're disposing of a majority of the part of your business, that's a fundamental transaction that's going to need a solvency and liquidity check. And people are, because they're looking at it from a group structure point, the group is healthy, the group is good, but individual companies within the group may not be. And now suddenly you're moving assets backwards and forwards because you're trying to collapse your structure or make it a more flat structure or more simplistic structure. And you've got to ask yourself, can you actually do this from a solvency and liquidity perspective? Because you might be moving all these assets out into another entity, but the entity that you're stripping has gone from insolvent to chronically insolvent. And then from the Companies Act, it's going to stop and say, well, is this actually the directors of that company? Are they making a good fiduciary decision? And there's some justification, not to say that you can't do it, but you've got to be prepared to justify what you're doing as to why it is good in the long run. And we've often come across where they're doing the numbers, so Carmen, they've worked out the numbers, they've worked out the plan, they've done all of this, and they just actually haven't done a mock trial as to what the situation will look like afterwards. And then suddenly realize when they look at it afterwards, they actually can't do any of this because they're sitting in such an extremely insolvent, illiquid position as a consequence of this. And then they have to try and go back to the drawing board and relook at what they've done. And it's not that they can't do it; they just have to look at a different set of tools to get where they need to go.
Yeah,
And I
think also here is to come back to, or to emphasize that point, is that when you have to always do the big picture view, because what you'll see is that as I start going through the tax side, is the corporate rules are housed in what we refer to as the sort of corporate rules section. And part of what Section 41 basically says is that for the purposes of these very limited sets of transactions, we will override our general income tax principles. But the problem is that because people have heard this so often that, oh no, you can do this with no consequences, they almost presume that it applies to every single other piece of legislation as well, when it absolutely does not. It only applies to income tax.
Yeah.
And the risk that we run into here is, besides what Caryn was saying about the liquidity and solvency tests, is you need to remember that when you go and move a business from company A to company B, the National Credit Act still applies. Your normal credit and debtors common law still applies. Your employer basic conditions of employment act still applies. You still have to meet all those other laws and all those other regulations to move from one to the next. Most importantly, your mortgage bonds aren't just going to, move themselves.
And one of the big ones we've often found are things like supply contracts or customer contracts that the person has negotiated with the brand that you have in that particular company. And you can move everything else, but you can't move that contract because you can't actually go back to the customer or supplier to renegotiate the contract. And this is where we'll head them back to our previous session on buying and selling of businesses, which really set up to today's session, where we looked at, do you buy the shares or do you do the property? We're taking that as sort of given. But it's exactly that, is that there are nuances that, okay, this is the plan, but now executing the plan becomes, have you thought about whether or not it's possible?
Yeah. So the saving of tax is only one part of the corporate rules provisions. You have to still factor in the other costs. And here, the most common example is moving property, because that's one
Yeah,
that we come across all the time,
yeah,
is you still have to go and pay a conveyancer to get the property, to get the title deed changed from individual to company A, or from company A to company B, or whichever permutation you're looking at.
yeah.
You still have to do the share register changes. All of those things still have to be done. You don't
Oh,
scope out of them because of the corporate rules.
my favorite one was Section 42 is, do you have enough shares to issue?
Oh, yes. We've seen that one.
Yeah.
So,
So,
yes. Anyway, coming now, let's move on to the actual tax toolbox then. I think we've talked about the big picture there quite a bit. The main thing is that generally, as I said, the idea of the corporate rules is that we override the normal. If I sell something or if I dispose to another party, then I have to do it on I have to do it at standard terms. Generally, what your corporate rules will do is try and avoid all the CGT, or all the tax consequences. Well, no, actually, avoid is very much the wrong word. Is they will try to defer all the tax consequences to a later date, to when it's actually realized. And that's another really big misunderstanding that people have about the corporate rules. The corporate rules are not a tax saving in the sense that it makes the tax go away. What the corporate rules are a tax deferral that allows you to effectively not pay the income tax now, but only pay it when you actually move it outside of the group. And that's what Section 41 is telling us, is that for the purposes of our transaction types that we're going to be discussing today, every single other piece of legislation gets overridden except for, and now this is quite important, is it's your general anti-avoidance provisions. It is our Section 1032 anti-avoidance provision regarding the utilization of assessed losses. It's the value shifting provisions in the 8th schedule. It's Section 24 Cap BA, which basically says that where an asset is exchanged for a share, then if there's a value mismatch between the value of the share given away and the asset received, or vice versa, then you effectively either have a deemed dividend or a deemed capital gain on that transaction. Section 25BB, that's a rate issue. Section 24I is your foreign exchange transactions. So you're still going to have to do forex, foreign exchange gains or losses on the translations and the movement, and those will come through as is. Everything else, though, you ignore. All right. And you'll see that the common theme of the items that are still scoped in is our anti-avoidance provisions. And this is something, and especially I find Section 24, those of you dealing with Section 42s, Section 24 Cap BA is the one that is very often very conveniently ignored by people. You will find people have come up with some very fancy structures. And also, this is the one thing about corporate rules that I have found, unfortunately, is that there are scenarios where you can have some really fancy restructurings and you can do some amazing wizardry with the corporate rules provisions. I still think my favorite is where I managed to do a sales transaction for 120 million where the purchaser didn't pay a cent. Okay, I was quite proud of that one. But I could do it because I structured it within the rules. What I found is there are a couple of, well, people who will tell you, no, you qualify for Section 42, but then they'll neglect to mention that these other anti-avoidance provisions still apply, and the transaction actually isn't going to be efficient once you factor in the anti-avoidance provisions. So my general rule of thumb is whenever you're doing a corporate rules transaction, the one exception is Section 45, but we'll get to that, is whenever you're doing the transaction, always make sure that you're trading like for like, that the market value of what you're giving away matches the market value that you're receiving, and then you're generally not going to have an issue. All right. This is especially true for Section 42s. It's that anti-avoidance provision is if you trigger Section 24 CAPI, I can just tell you blanket now, your Section 42 actually becomes pointless because the tax consequence you are trying to avoid is triggered by the anti-avoidance provision. So even though you may have a Section 42, you're still going to get the tax consequence. So please, 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 whatever you do, do not forget the anti-avoidance provisions. And this is also something where historically, there are a lot of people who forget this out of ignorance to an extent, because historically, the anti-avoidance provisions were scoped out of Section 41 as well. It's only been and it's actually been almost 10 years now, so people should have picked up on this, but, hey, I still had someone telling me that, SDC applied the other day, so stranger things have happened. It's only been in the last 10 years that the anti-avoidance provisions have been specifically brought in. So there are unfortunately also some people who haven't really made that connection yet. So please also just always be cautious when you're receiving advice that you are sure that all the anti-avoidance provisions have been considered. I've unfortunately run into quite a few, I have no polite words for them, and Caryn knows one of them very well, who didn't consider these provisions, and they're quite happy taking their fees and putting all the risk on the client. So please think very carefully about these, that you've considered the anti-avoidance provisions. Okay, and at that point, I'll get off my soapbox on that one.
But it's important to note, we got still people asking whether or not that you have to charge interest, and it's just, people don't catch up to where things are at now. They've got those ideas from the past.
So there's a couple of definitions that I want to also get into before we actually get into the nuts and bolts of the sections, because this is also, Caryn, where you're going to need to start chiming in, because this is where the accounting and the tax seriously diverge. And the first one is contributed tax capital. Now, contributed tax capital is, from a tax point of view, a very simple definition, actually. It really isn't that hard. It's basically...
you're saying it wasn't that hard?
No. I was saying basically, if you're looking at a class of shares issued by the company, right? It's the consideration which was accrued to the company for the issues of that class of share on or after the date on which that's for the resident ones. If it was a resident company, then we're looking at the value, or the value that you paid for the shares. Or we're then looking at, if it was a company that was in existence at 2011, in 2011, basically with the changeover in the dividend definition, then you had to have done a calculation at that point, and then it's whatever was contributed for the shares going forward. Right, so if we paraphrase that for foreign companies, post 2011, it's the market value of shares on date of change, consideration received for shares issued post 2011, any conversion amounts, reduced by, and then effectively your reductions are returns of capital or transfers to other classes of shares. In terms of local companies, that's part B of the definition. It's effectively my 2011 restated amount, consideration received, or if you do a conversion, whatever the amount of CTC was that was moved from one class to another on conversion, reduced by effectively returns of capital or conversions to other classes of shares, which sounds really simple, because basically for the vast majority of us, unless you have a reasonably old company now, it's going to be what was paid for each share issue, add shares converted into it, or reduced by returns of capital and capital transferred to another class of shares. Right. However, there is a yeah, there's some provisos to it. So effectively, that would be the one that we'd be dealing with most often. Right. And at this point, Caryn goes and says, okay, this sounds like we're the same, but
So the way that when you say CTC, automatically I want people to know this is the taxman's version of stated share capital. It's the taxman's equivalent. It's not my equivalent. It's not the same thing as mine. It starts in the same place, but it doesn't stay in the same place.
no. And just based off this, we can already see one area where there'd be automatically a difference between what you've got in your accounting records and what you'd have in your tax records. If you've got a company that was in existence prior to 2011,
that's the Old Companies Act.
That's Old Companies Act, and I'm only looking at pure share capital that was in existence at 2011, which may not be what you had as share capital for accounting purposes. Because you could have had
share capital. Yeah, I would be excluding my share premium account.
Or any capitalized reserves or anything else like that. So, yeah. So it would be, that's already one area where you're going to have a big difference. Then also the rules for how we deem consideration received for share issues may be different for accounting and tax purposes. If it's a cash payment, well, that's easy because those two are always going to align. But I can tell you right now that once you've done a corporate rules transaction, the two will not align at all. Because I do stuff at cost, Caryn does stuff at market value as a starting point. And then also once we get to some of the other sections, there's adjustments and proratas and other bits and pieces which have to be factored in as well, which cause differences.
My advice is going to be, in your stated capital note in your financial statements, have a subcategory in that note of contributed tax capital, because nowhere else are you actually going to track these changes. And somewhere down the line, you're going to need to know what your contributed tax capital is. For example, a dividend buyback a share buyback or something like that. And people are going to wonder why you're charging them dividends tax when they thought this was a tax-free transaction. And it's because of the CTC that you've got yourself into trouble. In accounting, it was a pure dividend, but for tax, it wasn't. A pure share transaction. And CTC needs to be tracked.
Two other areas that can commonly cause differences is if you do a share buyback or a return of capital. In either way, under the tax laws, you actually have to specify that it is a return of CTC by director's resolution. If you don't do that director's resolution, it's not a reduction of CTC, even though you may reduce your share capital for accounting purposes. Go figure. That's the way the law is written. Sometimes the law is just the law and don't try logic. Just is. The second one is if you do a capitalization issue. So in other words, where you do an issue of shares paid for out of reserves, any of your retained earnings. Now, for accounting purposes, you would still put that to stated capital, correct, Caryn?
Mm-hmm.
Yeah. But for tax purposes, that is not CTC. Because it's not actually a payment received by the shareholder for an issue of shares. So my CTC would not include capitalization issues. So that's another one where you can have differences.
Because with the cap issue, all I've done is I've taken my reserve and I've capitalized it into my share structure.
And as I say, the reason I'm harping on this now is you'll see that when we start going through the varying transactions, your ability to understand, your ability to identify the CTC becomes quite important, and some more than others, right? So that's that one there, right? So that's the first definition. The second one, I'd mentioned this one in passing, or mentioned it in quite a bit of detail in the anti-avoidance provisions, but this is just to give you an idea of the consequence of the Section 24 Cap BA anti-avoidance provisions. If you've got A who gives company B an asset worth 250 Rand and company B pays A in the form of shares worth 100 Rand, right? What would we normally do? So what would we do in terms of Section 24 Cap BA, right? Well, CGT is always calculated on the sale using what I received. So my capital gain would have been based on proceeds of 100. That's the value of what I received. But my base cost of the shares would be 250. Right. For company B, they receive the asset for the issue of shares. It's equal to the market value. They would have in a base cost. They bring in the asset at a base cost of 100 Rand in terms of Section 40 Cap CA, right? Which effectively means that you can transfer 150 Rands worth of value for no consequence. So what Section 24 BA says, no, hang on, there's actually an unrecognized gain there of 150. So I'm going to have to recognize a capital gain in the company by 150, and which means that I increase the base cost of the asset by 150. And A has to reduce the base cost of the asset they acquired by 150. So effectively, you take away that value shift by fixing it through a deemed capital gain. That's the end effect of what Section 24 Cap BA does. I'm not going to go through it in any more detail today, simply because we've got a bunch of other issues to consider. But what I hope this example just shows you is that you are shifting value in the original transaction because you aren't trading like for like. But the tax consequence the adjustment in terms of Section 24 Cap BA basically brings you back to a point where you've paid the tax on the value shift. Okay. So, those are the two big things I wanted to discuss before we get into the nuts and bolts. We've discussed this one already in each of those slides in details. Last definition for me. Group of companies.
Kind of important for this section.
Yes. So when I talk about a group of companies, and here straight off the bat, Caryn and I mean different things when we say group of companies. Because when I mean group of companies, I mean group of companies for the purposes of Section 41. And in my context, it means two or more companies in which one company directly or indirectly holds shares in at least one other company, to the extent at least 70% of the equity shares are directly held by the controlling group company or one of the other group companies. So to put away the legalese, I will only ever have a group of companies if there is a 70% holding in that company held within the group. So a holdco, which holds 50% of another company, that would be a group for you, hey, Caryn?
Yeah.
It won't be a group for me.
And another big mistake people make, because they see a 60% holding and go, well, this is a group, therefore we can restructure.
Well, you can, but you don't have a group for tax purposes. So so that's the other thing you'll see in the toolbox. Not every single, and this is also one of the reasons why people always had historically looked at the corporate rules provisions as only applying to the listeds, is because, well, how many people actually had groups? Because everyone tried to avoid doing consolidated financials. So you'd have 4 different companies, all with common shareholders, but none of those shareholders would be a company.
Trust, like an investing trust.
Yeah, investing trusts, or, you had the 4 brothers or the 4 siblings who each owned shares in 4 separate companies, and, they were each effectively matched, but that's not a group.
Yeah.
So for my purposes, please, this is incredibly important. When I'm looking at group of companies, I need a holdco and I need 70%. Now, that 70% can come from, for example, a company where you have the holdco, which holds 100% of company A, and then holdco and company A, say holdco owns 40% and company A owns 35% of company B. Now, that together still gives me 70% of company B, so company B would still be part of the group. So that would still work, but I need to effectively have a 70% direct shareholding through the group structure in order for it to qualify. Okay.
So just a quick one there. Companies Act says you are a holding company subsidiary relationship if you've got 50% plus 1, or there are alternative factors such as being able to appoint the controlling element of the board of directors. accounting is a little bit more fudgy. We're all about control, but how you demonstrate control. I could have a 30% holding, but control that company. I basically direct it and I gain the benefit of it. I don't need to have the percentages to have a control relationship. So that's why I say IFRS goes wonky. But I can create a group of companies. But the one thing we both agree on, it has to be a group of companies. And the moment I throw trusts and I throw other things in, we lose the group of companies. And then we start talking about common shareholding and we start talking about other things. But we do definitely need it to be a group of companies.
Yeah. So this is the definition of group of companies that we have in Section 1.1 of the Act. Section 41 then actually goes on to narrow that definition even further. And it scopes out foreign companies, it scopes out co-ops, it scopes out public benefit organizations and exempt institutions. Now, the reason this is important, if you really think about it, is, well, co-ops effectively are profit sharing arrangements where the co-op can basically just go and pay profits directly to the members and not pay the tax itself. So it can be used as a manipulation tool, as a way of reshuffling profits, which is why they're structured out of the corporate rules. Same thing with your PBOs and your exempt institutions. If I can freely reshuffle assets and they're included in the mix, I can very easily change the effective tax liabilities by pulling them in, which is why they're scoped out. Foreign companies, well, short version, SARS is quite happy for us to remember to defer tax consequences. But a foreign company is usually outside of the South African tax net, so which is why the foreign company won't be part of the group, because, well, they're saying is if I allowed you to reshuffle it with a deferral to there, we're effectively losing that amount. So therefore, scope out. You'll see once we get into the sections is that the way it's then worked is that they allow foreign companies can generally, rule of thumb, as soon as you have a foreign company, you scope out of any of the corporate rules transactions, unless that foreign company is a controlled foreign company in terms of Section 90. That's just a blanket rule. And one of those things we just need to remember.
And if anybody's wanting to know more about PBOs, exempt institutions, that's our next tech talk, by the way. That's non-profit organizations.
Right. We've talked about the provisos. Section 41.3 goes on to say that for insurers, there are certain other provisos which apply as well. And Section 41.4 goes on to say is one which I'm not going to discuss in detail today, but you'll see that certain of the provisions as we go through require you to liquidate one of the transacting companies. And Section 41.4 just clarifies what do we mean by liquidated. And the short version is that generally, if you go and read the different options that you have to have filed the appropriate paperwork with the appropriate regulators stating we are liquidating. So you have to have filed the paperwork. You don't necessarily have to have gotten the completion letter that it's all done and dusted. Okay.
You've got to be on the road doing it and committed to doing it, but they understand it takes time to finish.
Yeah. So if you're a little bit worried, please go and check Section 41.4. It takes you through in detail. And last but not least, Section 41.5 does give the commissioner the option to ask for a specific return where you've entered into a corporate rules transaction. As it stands at the moment, they don't. All that you do have is that if you have entered into a corporate rules transaction in a current year of assessment, there's a tick box on your IT-12 form, which asks whether you've been a party to. And actually, there's one on the IT-14, on the IT-14 and the IT-12, because for individuals, they could do Section 42s. And then for corporates, obviously, you'd have it in there. Did you enter into one of these transactions? And it's a yes, no. At that point, you just tick it and move on. There was talk for a period of time where SARS actually asked you to put in a specifically separate return, but that's since been dropped. But they could reintroduce it again. So that's just something to keep in mind at the moment. But please don't forget the tick box. Yes, ma'am.
Can I just put a point here that this is why it's so important to disclose these appropriately and correctly in your financial statements, because it could very well be the only place that you actually have the disclosure of what you did at a point in time And when SARS comes 3 years later and says, but why are you using the base cost here? And it's not the cost that I think you should be using. And you turn around and say, because it's a result of a Section 42. Where did you record this and where did you keep track of it? And we're finding often people tick the box, forget about it for 4 years, and then try and figure out where did the numbers come from or why are we doing it this way, whatever, because a new financial director's come in or something's happened and the institutional knowledge has been lost. But the financial statements practically are the holding space for this information.
Yeah.
I do feel important here. I do feel important.
No. You are very important. And it's one of those where I think technically in terms of IFRS, you aren't required to do that disclosure. No. But we really do think it's great. It's good practice.
Not to the level of detail we're going to ask you to do it.
Yeah. Because the one area where it will come through, and this is not a question of it may come through, hey Caryn, is it will come through is your deferred tax note.
Absolutely. Absolutely.
All right.
Just to give a headache so that they hang on until 12 o'clock, you've got day one deferred tax.
Yes.
I'll tell you more about that later.
So one other item, so that's what our overarching provisions are going to do. I've talked about market values as being a key concern, so I'm not going to go into that in any more detail. What I have just given you here is an example of where someone realized that calculating the market value of the shares wasn't as easy as they thought when they started actually issuing the shares, is because you have to remember that when you're issuing shares in an existing company with existing assets, that you can't just go and say, okay, well, I'm issuing shares equal to this value unless they're preference shares, because there's always a readjustment to what the growth in those underlying assets are. So please just be careful about your valuations and how you do this. Okay. The last point I'm going to make on big picture, even though we've addressed this a little bit before, is that as we start going into the detail of each of the respective sections now, please also remember this. There's a rule of thumb here which comes back to your cost benefit. The more complex you go in your structure, the more difficult it is to adapt in future, and the more onerous your administrative requirements become. And this is something which I have found time and time again as well, when you start having these conversations with your clients. And this is really where it also comes back to really understanding what the end goal needs to be, that people almost get like these blinkers and these blinders of going, I must save the tax now. And they don't actually really think through the long-term consequence of what it is they're agreeing to get there. There's definitely been situations where I've actually advised clients and said, you're actually going to be better off paying the tax now than doing one of the corporate rules, even though you qualify, because either the tax was low enough that the admin wasn't worth it, or they were the kind of people who hated admin. And in order to get a tax-free solution, you had to create quite a complex corporate structure. So please also always keep that in mind. You are always going to have to trade off complexity. My rule of thumb, the more complex the transaction, generally the more tax efficient, but it comes with long-term administrative costs. The less administratively complex, generally the more tax inefficient, but then at a lower ongoing administrative cost in the future with more flexibility. And that is always going to be your trade-off. Right. So what are the options? What are the tools in my toolbox? And effectively, you'll see that there's Section 42. Let me go back. There's Section 42, Section 43, Section 44, Section 45, Section 46, and then lastly, Section 47. So there's 6 specific sections that are available in the toolbox, which each have their own pros, they each have their own cons, and they have some wonderful practical applications in terms of how they can be used. So what I'd like to do, what I'd probably like to suggest is, we've thrown a lot of information at you, Caryn, is that we're almost at the hour, is that we take a break now, and then we'll spend the next hour going through those 6 different sections and what they can do for you, what they cannot do for you. And then we'll leave and then we will leave the accounting for the last hour, so that we can.
If you also, just from a timing point of view, if you give me half an hour, that's enough.
Okay.
I'd rather than get your side done perfectly.
So, Leonie, there was an issue with the loading of the slides, so that I don't know if that's been uploaded yet, but you will be getting those through as soon as possible.
It is in the chat box earlier, but Jeremiah from SAAA it should be under your resources. It has been shared as it needed to be.
Yeah. Okay, but I think this is a good spot to take a break. I have the time as 10 o'clock. 10 minutes normally is our usual, hey, Caryn?
Exactly. Yeah.
Okay.
Perfect.
All right. See you all in 10 minutes. everyone, and welcome back. Hope you all are suitably rehydrated and refreshed with beverage of choice. I know for me at the moment it's coffee. So yeah, let's talk about our different sections. So Section 42 is the one we've mentioned the most, and I know it was a lot of what you were talking about. Have said was what you were here for. So Section 42 is also the one section which doesn't actually require a group of companies, which is one of the reasons it has such a wide application. And it's used for a situation where any taxpayer has an asset and they want to give that asset to a company in exchange for a shareholding in that company. Okay. So ultimately, the shareholding in that company is, one of the reasons Section 42 works is that the sort of fundamental philosophy behind it, as it were, is, and I'm going to use an individual as a company as the main example because that's where it's seeing its biggest practical application at this point in time, is what the the thinking behind the design of Section 42 is to go and say, pretend you'd never actually bought the asset in your personal capacity, but pretend you'd originally invested it into the company and the company had instead gone and bought the asset. So if you've got a piece of land which you'd originally bought for 5 million rand, just to use some numbers, then effectively what Section 42 allows you to do, and let's say that property is now worth 15 million, that you can go and say, right, I am giving my property, which is worth 15 million, to the company, right? The company, but I will do it at no tax cost. Essentially, I would basically go and say, pretend I'd given the 5 million direct to the company and the company had bought the asset for 5 million. So at the end of my Section 42, I will end up in a situation where I won't own land with a base cost of 5 million anymore. I will own shares in a company with base costs of 5 million. The company's balance sheet for tax purposes will show CTC of 5 million and land with a base cost of 5 million. All right. Now, here's again, we will go through each of these sections in a bit more detail. But this is just to give you an idea of what the toolboxes are and what the principles are. And as you can see, that the strength of what a Section 42 is trying to let you do is it's trying to say, all right, you started this business in your personal capacity because you weren't quite sure whether it would work. You didn't know how long you were going to be using it for. It was easier to do in your personal capacity, whatever the reasoning. And it's now grown to the point where you actually want to corporatize it. So I shouldn't penalize you for the fact that you started something, you've grown, and now you want to become more legitimate. Again, using scare quotes there, it's not really true. And ultimately, Section 42 works, where as long as the person who owns the asset becomes the shareholder in the company. Right? This is something which is a common misconception with Section 42, is that the person who owns the share must become the person who owns the assets. Right. Other common misconception with Section 42 is that for tax purposes, the company acquires the asset at the original cost. The base cost in the company doesn't reset to market value. Right. It is a deferral of a tax consequence. It is not an eventual tax saving. Okay, which is also something which always needs to be taken into account when you enter into these transactions. Okay. The benefit of the Section 42, though, is that it does give us flexibility and it allows us to actually start off small and then adjust as we go forward. I've also seen this, and one of the big reasons I've seen Section 42 become so popular is because of the changes to the deemed disposal of assets on death. So sole props are really becoming quite punitive, and especially in the farming communities, this is a huge concern because, if you have a whole herd of cattle, if you die, Section 9HA basically says that you have to dispose of those cattle at market value and pay income tax on them. Whereas if you went and moved the assets into the company, you moved your cattle into a company and corporatized your farm, you would only on death, you would own the shares, and you'd have a deemed disposal share of the shares and pay CGT. And now, even if you've got a reasonably small herd of cattle, the income tax differential of 45% on, a herd with 10 million versus this paying CGT on a herd of 10 million. I mean, it's the difference between 45% and 18%. That's a lot of money that on death suddenly becomes worthwhile, right? Obviously, Section 7C was another big trigger for why Section 42s became so popular, because we wanted to move assets out of trusts and into companies. But really, Section 42 can be used in a whole variety of different circumstances where you want to trade assets for shareholdings. And as I said, I've used examples of individuals here, but there's also a lot of corporate reasons for why you might want to have an asset for share transaction. For example, if you've got an existing company that wants to bring in a new partner, and that partner doesn't have cash, but they've got assets that you find worthwhile, then that's a great way of bringing in the new partner in a way that is tax efficient for the partner. So there's a real benefit to the Section 42, and its strength is because it's flexible and it doesn't require a group. All right.
But we also use it quite a bit in structuring, because people sort of take the assets out of a company, put it into another company, and then they shut down the company below.
I found also that Section 42 is a good gateway drug. Is that a good way of putting it? Of how to get into the corporate rules? Because a lot of the other provisions require a group of companies. So at least by using the Section 42, you can actually use the Section 42 to create a group of companies in the first place. And once you've got that group of companies, you can then go and play with all the other provisions. So in my experience, Section 42 is almost the gateway section to, if you don't have a group and you need a group to do the rest for you to get to that position. And most common places where I've seen that is, for example, where you've got 4 companies who have common shareholders but no holdco. Then step 1 is always every single one of the common shareholders. You create a holdco, and each of the common shareholders, Section 42s, their individual shareholdings into the holdco, so that you eventually have a holdco with the 4 companies underneath, and your 4 common shareholders now are only shareholders in the holdco. All right, so that's why this is such an important provision, because it really helps you create the group. It can help you create the group company structures that you need for the other provisions to apply. You're muted, Caryn.
Sorry, I've got gentlemen here helping me with the fiber, so that was the delay that I had just now. I was going to say it's a tidy up section. So often you've got these convoluted structures, and I mean that's the whole thing of business restructuring. But this is often if there's a simple solution, often 42 can be a simple fix, or the beginning of a bigger structure. Anyway, okay, I'm going to keep quiet now because this is your section.
No, but it's true. So as I say, it's so versatile. No, but you see, Erica, that's exactly the point. SARS is not interested in this because it's a deferral. That's why, yes, there are T's and C's and there's anti-avoidance provisions and all sorts of, we'll get to the T's and C's in a second. But that's the beauty of this provision, is because they recognize the fact that there are times where I genuinely need to change my structure because my business needs have changed without actually realizing a true profit, without my net worth actually changing. And that's what Section 42 is trying to achieve. So it's a great tool to use for that exact purpose. That's exactly what it is. But that's also why the anti-avoidance provisions are still scoped in to make sure that it's not abused. So
yeah. And it's because of that deferral. Hint, hint, deferred tax. So people always say to me, Caryn, what is deferred tax? Or what? And I was like, taxes that are deferred. can I just say,
That's not helpful,
anytime-
Caryn.
no, but it's a trigger. Every
Yes.
time you say to me, Caryn, this tax consequence is going to be deferred into the future, I go defer tax. And there's going to be a difference because accountants have to record that liability now for this future consequence. So just giving you a hint.
And I'm going to spoiler alert Caryn's section here a little bit, even though we've already mentioned this already. Please note, I am saying that for tax purposes, I am doing this at cost. Caryn, what's going to be?
Purposes.
Okay.
Everything is done at fair value. So accountants work at acquisition date. It's fair value. It's a business combination at fair value.
And that's why you have deferred tax from day one.
Yeah. Because my carrying value is at fair value, but my base cost is at base cost at the value that you've brought in.
And this is something which is a concept that a lot of accountants struggle with when it comes to the corporate rules, because they kind of look at this and go, but there's no taxable income. Why am I reflecting an accounting profit?
Well, it's not it doesn't.
For the person who's selling the asset and getting the shares, they are making a profit because they've disposed of an asset and getting something of higher value back.
Yeah.
And I often have people tell me, yeah, well, at what are the values I use for a Section 42? And the answer I answer there is, are you asking me for tax or are you asking me for accounting? Because the answer is different.
Yeah.
And they generally go for both. I'm like, well, it's cost and market value for accounting. No, but they need to be the same. No. and as
your
long as
shares
we
are
can
going to
get
be
that straight. Yeah.
Yeah, so for accounting purposes, and think about what value you're going to the title deed or what the deeds office or are you registering your shares at? You're registering your shares at fair value. Sorry, I've got literally the train station happening behind me, but anyway, we'll carry on.
So it's also, please remember, these are the values for tax purposes. And I really can't emphasize this enough. It's for tax purposes. Your share certificates. If I use my example of the 5 million land, which I give to my company today, the share certificates would be issued at 15 million because that's the current market value or fair value of the land. But the CTC is only 5.
And that's why we need to record it in your share note as a separate element, because nowhere else will you know that it's 5.
So that is Section 42, as I say, to me is the most commonly applicable and the most often used section. Section 43 is a section that used to be incredibly powerful. And honestly, it's at the point where I only have it in now for the completion of for completeness purposes rather than it being really effective, because literally Section 43 now only applies where you convert linked units into ordinary equity. And a linked unit is defined as a listed share, where you have a listed share linked with a debenture. So it's a joint listing of a share and a debenture on a recognized exchange, which is then converted to a plain share.
So that's very specialized.
Well, and I mean, how many of those do you actually even know of in existence?
Yeah, because that would be a compound financial instrument for me.
Which is why it used to be any share, as long as it was being traded for another share, could be done via Section 43. Right, that's gone. So yeah, that's all I'm actually going to say on Section 43 for the rest of the session, because to me it's just irrelevant. Section 44, on the other hand, is our next section, which is in the toolbox, which I think is very useful, which deals with amalgamations. Now, Section 44 talks about transactions where the intent is to merge two entities into one. So you've got Company A, Company B. You want them to merge. So we did have one of our delegates say that a merger was part of the problems that they were looking at. So Section 44 is probably going to be the one you want to look at. And it's all you do is then one of the companies will sell its shares to the other company. And the end result of it is that you channel so Company A gives all its assets to Company B. Company B then gives shares to Company A in exchange for the assets. But company B then liquidates and passes the company B shares up to its shareholders. So the end result of that transaction is that at the end of the day, company A is liquidated, all the assets are in company B, and your shareholders of A and B are now joint shareholders of company B. That's what Section 44 is effectively achieving. This Section 44 is obviously very helpful if you're looking at merging businesses, if you're wanting to bring in new partners, if you have previously had a structure which has like 100 different companies and you now want to consolidate some of those transactions. That's what Section 44 is really good at. The one downside to Section 44, which is one of the reasons why it doesn't always work for people, is that in order for Section 44 to apply, the company that is disposing of the assets, so in other words, the one that's giving its asset to the other company, has to be liquidated. And sometimes, especially in the SME space, people get funny about some of their companies because
they get attached to them.
Yes.
They're sentimental. We've got some clients that collect companies.
Yes. It might have been that was the company that your father created for you back in the day, and now you don't just want to go and, as much as you understand that the practicalities of moving it into another entity, all of that kind of stuff. But whatever, sometimes Section 44, the big snafu with Section 44 is the fact that you have to liquidate the company disposing of its assets. All right. So, and no, we do not need the companies to be a group before the transaction. In fact, it's so Section 42 doesn't require a group, and neither does Section 44. All that Section 44 requires is that at the end of the transaction, you effectively have a company which is completely liquidated and a joint share with all the assets moved over into the other company, and the shareholders of the two companies effectively become merged.
And can I just put a little fly in the ointment here to say that accounting doesn't believe in mergers. Accounting believes in acquisition accounting. So we will have it that one of these parties is going to control the other. One of the parties is going to be the purchaser to the other party being the seller. Just for our point of view here, so it's going to be a business combination. It's not going to be happy families hold hands and kumbaya. Somebody's going to be the trigger person. Oh, pretty.
I don't know what happened to my presentation there. Excuse me for a second. Yeah. So that's the one other tool in the toolbox is Section 44. Right. Section 45 is the one which everyone knows when it comes to the corporate rules, and it's the most commonly applied. But Section 45 very much does require that you have to have a group. So for this one, in order for you to do this, this must be group. And from a policy point of view, SARS has basically recognized, well, National Treasury actually, because they write policy, is that if you are running a big group of companies, sometimes you just need to reshuffle stuff because it's more practical for varying reasons. And Section 45, you can see, is really just saying, I've got an asset in company A, I want it in company B, poof, make it appear in company B. Whereas Section 42 and Section 44 both require a transfer of shareholding, and these are very clear that there must be like an asset traded for a share, or a Section 44 is that you must have a company giving its assets to another company and the ultimate shareholding then moves up. Section 45 just says you gave an asset to another group company. That's it.
And what I see with this often is, you've got one particular company in the group that's been doing something, and suddenly you're sort of saying, well, the purpose of this company's changed, and we need these assets to go into another part of the company, or maybe this company had the finance in order to be able to acquire the asset, and now it's actually not meant to be in this company, it's actually meant to be into the other company, and instead of leasing the asset across, we actually just want the asset to be owned in the right place. So it's sometimes comes from a financing point of view, or a change in strategic policy as to what this company does, and that you're just getting things right. I've actually got one of those on my desk at the moment. Yeah.
And And here's also then where, just to give you an idea of how you can back to back some of these transactions, is I've then got, if you've got someone who genuinely just likes the idea, or where you've got two different parties who want to be able to move assets, then you could have individual A and individual B, each with respective companies, where you create a holdco and they use Section 42 to transfers their company A and company B into the holdco. So now effectively you've got the two individuals, you've got a holdco and two subsidiary companies. Once I've done that, I can now freely transfer the assets between the two underlying companies without incurring any tax costs. Because where I've seen this become quite useful is that it can be a great, again, long-term planning tool in estates. For example, if you've got companies which each have different business operations and maybe different properties or different investments, which are each currently housed in separate companies, and long term, you know that the two siblings who own this whole hodgepodge want to actually split, and sibling A wants these assets and sibling B wants those assets, then it might be an idea to actually create the group, and then you can restructure and reshuffle the assets into two separate companies, which can then be split in a couple of years' time into whichever portion that they respectively want. Alternatively, this could be a way in which you can still go and merge businesses, but without having to liquidate any of the underlying companies. So there's a lot of strength to the Section 45. And it really does help to create a scenario in which you can reshuffle the deck chairs without it being a huge tax issue. Probably the most common application I've seen of Section 45 is where people use it as a way of creating deductible interest on loans. So the method there that you use there is, if I take out a loan to buy an asset, then I can generally deduct the interest because it's in the production of income and I can show how I'm using the asset. But if I borrow money to fund shares, that interest is generally not deductible. So what people have done in these transactions before is that they'll have, for example, a piece of land in company B. They'll have company A take out a mortgage bond and buy the property from company B. So company A now has a debt with deductible interest because there's property, they could forget the financing, everything was happy, and they've paid company B. And company B can now go and on-lend it to whoever, or go and borrow them, or go and spend and buy the shares. And effectively, it doesn't matter that the interest is not deductible because you've got the deduction in the other company. So there's always ways and means as to why people want to do this. And it's also, I think, really, one thing you'll realize the more we go through this toolbox is the only limit to how these can be used is actually your creativity and understanding the problem it is that you need to solve. Because Section 45 is simply a limitation on recognizing a tax consequence as you have it at that point in time in the transaction. The one big stick to Section 45 is if you do use it to move assets between group companies, and within 6 years, the company that acquired the asset moves outside of the group, there's what's referred to as a degrouping charge. You'll also find that, as a rule of thumb, whenever you do a corporate rules, there's generally an 18-month waiting period because there's an anti-avoidance provision that applies. And then for Section 45s, there's the 6-year degrouping charge that you have to consider in terms of if you want to use a Section 45. So those are two big general caveats. Always T's and C's that apply, but that's something just to also think about as well. So that's Section 45. Section 46 is now trying to solve a different problem. Section 46 is where you have previously created quite a complex structure, with the holdco, subco, sub-subco, sub-sub-sub-subco, and varying. And you want to create a flatter group structure. So basically, you don't want that deep line down. You want more of a pyramid shape for whatever reasons. So you want to move shares up to create sister companies rather than subsidiaries, sub-subsidiaries, and all the rest. And the aim of Section 46 is to go and say, if I go and declare these shares up as dividends, they still remain within the group, then effectively I can do that restructuring with no immediate tax consequences. Okay. Does mean I have to change my CTC and base costs and all those other bits and pieces, but there's not going to be any tax payable. And the last one is Section 47. And Section 47 basically says, if I've got a subsidiary company that I no longer need, I can basically just go and almost lift the entire trial balance, plug it into the holding company, and just liquidate the underlying company and move on. That's what Section 47 is trying to do. Is it saying, if you liquidate the company, you can move the assets up to the holdco and you do everything at base cost. You basically take that entire and just plug and play it into the holdco. So if we go and look at these then in terms of what they allow us to do. Sorry, I've gone back too far. Section 42 helps us exchange an asset for share. Section 44 helps me merge businesses. Section 45 lets me move assets between group companies. Section 46 helps me simplify my group structure, and Section 47 helps me liquidate companies. Now, 47, 46, and 45 require a group of companies. 42 and 44 don't. Right. But between those five, and I know there's Section 43, but as I said, I'm ignoring that. But generally, between those these five transaction types, we can deal with most restructuring needs as long as we are willing to, if we back-to-back them. There's very little that you can do that wouldn't help solve a problem. I mean, for example, one of the things that I've done before for a BEE transaction is where the shareholder, where the BEE partner didn't have much in terms of funds in order to buy into the new company. And also, the existing shareholders didn't want the full operations to go to the BEE entity. You know the standard story. So what they did instead was that they actually had the current OpsCo create a subsidiary. And the OpsCo then sold the business operations to the newly created subsidiary. But they did that then using Section 45. So now I'm in a situation where the subsidiary company effectively, for all practical intents and purposes, has a net asset value of nil, because although the full operations have moved across, there's a huge loan liability back up to OpsCo. OpsCo didn't have to pay any income tax on those transactions because they used Section 45. And now the new co or the subco can go and issue shares to the BEE partner at negligible value as long as they stay below 30%, because I still need to remain within the group, because the net asset value of the company is nil or close to nil. So there really is your imagination and your ability to think through a problem. There are very, very limited circumstances where your corporate rules are not going to be able to help you get to the answer. The only times your corporate rules are generally not going to get you to the answer you're looking for is if ultimately you want to actually change effective shareholdings, where what you're actually trying to do is sell your business but pay no tax, even though you're actually selling out and you're saying, I want cash out. That's the one thing your corporate rules will not do. But if you're simply restructuring, your corporate rules will generally get you there.
Because at the end of the day, you're still within your space. It's only when it exits to third parties that they start to pay attention.
Are there any questions on that before I start looking at some of the detail of the sections?
One of the things I find useful is for you to look at your situation as it is and be very honest as to what the situation is as it is, and then look at your ultimate end picture. So where is it that you want to land up at the very, very end? Because then you can see whether you're using the N3 to Durban, whether you go in the R103 to Durban, whether you are using the N3 to Cater Ridge and then going on the old road. But you know that your destination is always to get to Durban. And that's the important thing, is to keep sight of what you're trying to achieve with all the reasoning of what you're trying to achieve. Because then you keep those principles protected as you do these things. And then it makes the decision, well, do I move the assets, or do I do this, or do I liquidate, or do I do that, or do I do this? Just keeps you focused on what you're trying to achieve. And we often find people start this and they have an idea, but they don't have a clear idea. And then they do false starts here and there, and then they have to backtrack and restart it again. And that's when things get expensive and ugly.
So I think also there's always, you have so much flexibility, and that's sometimes the scary part, right?
That's why you need to have a clear vision.
Yeah. So what I wanted to do for the rest of it is, you'll see that in the notes I've given you, I was actually just going to check. So all 170 slides of my notes.
Hence the warning in the beginning. I had a heart attack when I saw that.
No, but I was going to say, and those are my slides, is I want to pick out sort of the key principles of each of the act, but also this is where I'm going to be guided by you in terms of what are some of the questions that you have, so that we can address those, and I make sure that I've discussed them. But don't be afraid then, therefore, that if I'm skipping out some of the stuff, that you've at least then got it there as reference, that you can go back and refer to it as. But this is also the reason why, to be brutally honest, I mean, I could very easily run 3 to 4 hour sessions on each of these sections, barring section 43 individually, because there is quite a bit of nuance to it. But the broad principles are the same.
Yeah.
So what section 42 is effectively then trying to achieve is that, remember that as a standard rule, section 42 is saying, I had an asset, I'm giving it away for a share. So if you've got a machine with a base cost of 10 and you get shares worth 150, which is also the market value of the asset, right? So picture some really super duper fancy machine where the value actually went up, just for illustration's sake. Then in terms of our base rules, what I'd have to do here is to go and say, right, the Pty Limited acquired the asset for 150, right? I don't have to apply the anti-avoidance provision because it's like for like, right? Joe sold an asset. He'd have a recoupment of 80 because he's claimed allowances on it. Plus, he's also going to have a capital gain of 60 on the sale of that asset. I mean, that's our standard base tax law. So what section 42 effectively allows us to do is say, no, pretend I'd never done that. So effectively, I'm going to go back to my example. So if we go and say, now take that exact same example and apply section 42, then what changes is that for Joe, instead of using the 150, which is the current market value, his proceeds would become 10 and his base cost is 10. He also wouldn't have a recoupment because that rolled over to the new provider. The PTY would acquire the asset at a base cost of 10 and deemed to be owned it for as long as Joe has, and the PTY would have a contributed tax capital of 10. So, yes.
For accounting, this is where we go. I think it's good to just sneak in here the parallel.
Yes.
For accounting, the market value of this is 150. So I take it as a sale. He sold this asset at 150 and will have profit on that disposal of the difference between 150 and his carrying value. That's going to happen in Joe's hands. In the acquiring company, they've acquired an asset with 150 and issued shares for 150. So on the face of the balance sheet, I'm bringing it at market value, even though my tax values on the other side are sitting at 10. So I have deferred tax because I'm showing an asset at 150, but you're giving me the base cost of 10. So I've got deferred tax on that 140 difference. Now, I can't put that to profit and loss, people, because this isn't a profit and loss transaction. This is a day one acquisition. That is going to go to a negative reserve. Okay, so it's going to go to a negative reserve. It's going to be a Section 42 deferred tax reserve, and I'm going to raise a deferred tax liability because I've got a future, when that asset exits, I've got my base cost that I've got to go back to calculate the tax issues on all of this. I also have CTC in my financial statements of 10, even though I've issued shares at 150.
And wasn't there some horror story about them bringing deferred tax on share capital in the books at some point? Okay, no, I'm not going to go there.
Yeah, but also, I mean, if you then do a share buyback, your return of capital is 10, not 150. I see 150 when I'm giving you your shares back. I don't see 10.
I think there's a few points that I want to raise at this point. There's, as I indicated, there are a lot of people who have this idea that the base cost of the asset in the PTY should be 150. It is absolutely 100% not. It is a deferral of a tax consequence. It is not a tax saving. And I really can't emphasize that enough.
Because eventually that difference of 140 is going to have to be paid. When it exits the group, when it goes to third parties.
Right. So that's effectively the big picture aim of Section 42. What do I need in order to be able to apply it? Right. Short version, I've got the full definition there if you want to give it. You have to give an asset for an equity share. Now, this is something that's really important and something that a lot of people still miss. Equity share, by definition under the Income Tax Act, means a share which does not have a limited participation right. In other words, there is no cap on my right to participate in either the profits or the capital of the business. So my old school preference shares would not meet the definition of an equity share for the purposes of a Section 42. There must be fair and equal participation rights ranked equal with all other shares in order for it to be considered an equity share. Right, so that's one big problem. Second big issue conceptually is people often think that, okay, well, I own the asset so I can give my trust the shares. No, it's the person who owns the asset has to get the shares. Second, it has to be local. The market value of the asset must exceed the cost. And at the end of the transaction, I have to have a qualifying interest in the company, or I have to be an employee of the company. All right. What do I need for a qualifying interest? Generally, for our unlisted companies, we're looking at a 10% voting right in that company. Okay, so that's the one that you're probably going to have to deal with, but there's your other definitions of qualifying interest. Okay, so to simplify it again, asset for equity share. Local assets, local company, you have to trade like for like. So I have to have a capital asset that's going to be used as a capital asset or trading stock that becomes trading stock. The only one that you can switch around is you could trade a capital asset for something that becomes trading stock. Right. Please note, and this is also something which seems conceptually off, is I could give you a 150 Rand machine and get 10 Rands worth of shares back. That is still a Section 42. The problem is if I have a value mismatch between the value of the shares that I receive and the value of the asset that I gave away, it triggers Section 24 Cap BA. And that's the anti-avoidance provision that a lot of people conveniently forget to mention when they're looking at Section 42s. Is if you're not trading like for like, you may still have a Section 42 and be able to defer the capital gains and everything else in terms of Section 42. 100% agree with you on that. But then you have to apply Section 24 Cap BA. And that's probably the biggest conceptual issue I have with that.
No, I have a bigger conceptual issue with Section 42, which people, and I know it's going to happen because we've already got people doing restructures and that. I hope people have heard what you've said all along, that you've said asset for share.
Yeah.
You never at any point said net asset for share.
I was getting to that one.
Okay.
Okay. So that is the criteria. Are you happy with that? Is that something that I hope I've gotten the big picture? The final point I'm going to make on Section 42 is exactly what Caryn was discussing. Okay. That's what I've kind of indicated in the numbers. That's what I issue the shares for. There's the example. Is two principles. Principle 1 is, just to continue on the Section 42 vein, is this is meant to be a concession for where you've basically you haven't actually changed your effective interest. You've just changed how it's held. So I put it into the share, I put it into a company as opposed to owning the asset myself. And SARS and the policy is that they're quite happy where all you're doing is reshuffling the ownership to give you the concession. But if you're actually realizing value out of it, they want their slice of the pie. So housed in Section 42 is very much an anti-avoidance provision, which says that if you're getting shares and something in addition to the shares, then you have to pro rata your Section 42. So if I made the argument with my share, with the example I had here of where the machine's worth 150 Rand, I'm getting 100 in shares and I'm getting 50 in cash. What I'm going to do is I'm going to be able to defer 2/3 of my capital gain, but I'm going to have to recognize 1/3 under normal rules. And that's why I'm saying the anti-avoidance provisions or the concession only applies to the extent that I'm being paid in shares. Now, to tie into the point Caryn was making, is there's two issues with this, which come in with this. Issue 1 is what a lot of people conveniently forget. Consideration doesn't just have to be cash. If you take over my debt, that is consideration. So if, for example, I had bought my piece of land for 5 million Rand, and it still had a mortgage bond of 5 million Rand attached to it, and you give me shares and take over the liability, then the way Section 42s look at it, they go and say, but you're being compensated twice. You're being given shares and you're being relieved of an obligation.
Now, I just have to say, you've got to get into almost a CGT mindset about you no longer have that obligation. That's what you've got the benefit from, is not having to lie awake at night worrying about the debt. That worry has gone away. Because once I started thinking of it like that, I started to see your point of view, because up until then I thought you were talking monkey business. But anyway.
So the short version is release from a liability is consideration.
It's not the liability, it's the release from the liability.
Yes.
You've got to make that very, very clear, because accountants go net asset.
Yes. Section 42 is premised on the idea that this is a fully paid for asset. I don't care how it was financed. I am just taking the asset and moving it. Anything else falls outside of scope. And that's conceptually sometimes, which is an issue which is slightly difficult to explain and also sometimes to conceptualize.
Yeah, because most people want to just, they've got that farm and they just want to cross out the name and put the name of the company on top of the trial balance. But what they don't realize, it's the assets. If you've got debt that's moving with this, you're complicating this. You're seriously complicating this.
If it's debt that goes with it, Section 42.8 or Section 42.4 and 42.8 then have to come into play, and basically you have to pro rata your deferral between the value of the shares and the value of the release from your debt obligation, because it's considered part of your consideration, right? That's okay. So that's where I get. So how does Section 42.4 tell us to do this? Basically split between the transaction and the normal, and the ratio I use is the market value of the other consideration over the market value of the total consideration received. Right. There is, however, some relief in Section 42 for scenarios like where your property moves with a mortgage bond. And there's two provisions which apply, which basically go and say, if my debt moves with my assets, then I change that pro rata rule. And the two criteria in which I can use a different rule other than the pro rata is if the asset secures the debt and the debt is more than 18 months old, or if less than 18 months was incurred at the time of acquisition. Right. So for my property where I enter into a Section 42, but the mortgage bond moves with, as long as that mortgage bond is secured by the asset, which this should be, then it's easy. Then I can apply Section 42.8. I don't fit into 42.4. I think the important point to remember is that as soon as debt moves with your asset, you're either in 42.4 or 42.8. You're never not going to be in one of those. 42.8 is just a lot easier to apply than 42.4, to be brutally honest. So if you're going to have to move debt, you want to be in 42.8. That's probably the big picture principle that I would leave you with at this point. The other way in which you can move the debt is if you are doing a going concern disposal, and the debt is part of the normal course of the business undertaking. So, for example, if you're selling your whole farming operations, your trade creditors would fall into Section 42.8 then. What does Section 42.8 do? Right, effectively, whereas Section 42.4 tells me I have to go and recognize the full capital gains, 42.8 says take the amount of debt that was moved and effectively defer and effectively you would have to do a reduction in base cost equal to the amount of debt that's taken over, or a reduction in your deductions. I've got some examples here. Give you a minute to read that.
You have no idea how often I pull this example out to show people. I literally have it bookmarked for consulting.
All right. So this question is, we could probably spend the next hour just talking about this example because it ends up having that effect. But what I wanted you to get out of this is to just see the differential between a standard 42, a 42.4, and a 42.8. Right. So scenario 1 is effectively a standard Section 42. Oh, for crying out loud.
At least you didn't say crying in a bucket.
No, it's my PowerPoint is for whatever reason not working with me today.
We're having technical issues. There's gremlins in the system.
Yeah. So for a standard 42, it's got a original cost of 650, right? So the land has a base cost for the new co and the CTC of 650, and shares, and Joe, he'd originally created the company for the R1, so the base cost is now the 650 from the Section 42 plus the original one. Okay, I don't think there's anything to, that's the easy part. Now, the solution to part 2 is a little bit more complicated. And this is where the accountants often sort of tell me I've lost the plot. In this case, if we go and look at it, I have an existing liability of 100,000 that I'm taking over in addition to the asset. So from the newco's point of view, using because I can use the Section 42 rules or 42.8 rules, I can still take over the land at the original cost of the 650, but I've now actually gone and paid an additional 100,000 for it. So the base cost is actually 750,000. The CTC, however, is still only 650. So from a tax point of view, and Caryn, don't tell me I don't balance, is I do, because effectively from a tax point of view, I'd have an asset with a base cost of 750, and my credit portion would be CTC of 650 and a liability of 100,000. That's effectively the original concept, right? Joe takes over these shares at a base cost of 650, but with a delayed capital gain of 100,000. So it's an effective reduction of 100,000 to his base cost. And that's why I was saying 42.8 actually makes the moving of the liability a lot easier, because in scenario 3, where I don't qualify for Section 42.8, what I have to go and do is then go and say, all right, I now have to grow and pro rata everything between what was done via Section 42 and what actually happened at market values. Okay. And I think I'm going to have to give people some time to think about that for a second.
Which we've got a break coming up.
Yeah.
But there is a rather long...
Yeah. There was a question there. There's a question which has come through. And the question was, well, what happens if I own an asset? And I'm hoping that my Joe example helped answer the question, because it's effectively that kind of idea where you have a company that has nothing in it other than the asset I would give it. And when you go and look at the value that I have to test, I have to go and test the market value of the shares after the asset's been acquired, not before the asset's been acquired. So if I've got a company that's empty and I'm going to be the 100% shareholder and I put an asset in, then it will always be like to like. Because I had an asset with a value of 100 million, for argument's sake. I move it into the company that was currently empty, except maybe for 100 rands worth of share capital. And at the end of it, I'm going to own a company with a market value of 100 million, because that's the value of the assets. Okay. So that's fine. Where these get messy is if you're moving assets into existing companies with other shareholders, because then there's a big potential for you to actually have a value mismatch, because you need to check that you're actually getting fair compensation back. And that's the example that I had in the intro portion of the slides, where you'd have to consider it. So your test for market value is the market value of my asset before the transaction, but the shares you value once the transaction's completed. That's my testing date. Okay.
I can see somebody's typing a response, but it's like it's sort of typing and then stopping, typing and then stopping. So,
Caryn, I think it's probably not a bad idea to take the break now, because then you can also have any other questions. Yeah. And then we'll go through 44, 45, and 46 quite quickly. I mean, actually, 44 and 47 are actually very easy in a lot of context.
Yeah, 46 is the one that, if I had to... yeah, I was just going to say 46 is the one that in my practice and in our practice, I think I often link 46 and 42 together. But that's just me and just the way that it structures for me. Although we have done some with the 40, on which one? Anyway, you'll say it. But I think a break just to let this settle in the brains. Should we another 10-minute break? So to take it to 11:15?
Perfect.
And then in the break, if you're wanting to post these questions, if you're chewing on, you want some thoughts, please post them during the break, and we will
We'll get to
catch them on the other side.
Alrighty. So there's one other question which has come through in the meantime, which said, if on exchange of shares there's a liability outstanding which is settled by the company acquiring the asset, how do you deal with the monies that were paid to settle the debt? So effectively, John, that for me would be then a straight Section 42(4). And because it's a payment of consideration in excess of just the shares, so you would be in part 3 of this solution and of this example, and you would have to go and do the pro rata. Okay, I know it's not what everyone wants to hear, but unfortunately, that's what it is. Okay, so for the next bit, I'm going to skip through the Section 43s. As I say, that really is not actually okay. Last point I'm going to make on Section 42 is a lot of people still have it in their have this idea that you need to specifically call it a Section 42 transaction in your agreements, otherwise it doesn't apply. That's also 10-year-old thinking. It used to be that you had to opt in to corporate rules transactions. They now actually are opt-out transactions. If you wanted to not apply when you meet the criteria, you actually have to specify it in your agreement. And this is something which is very commonly missed. And yeah, so just please remember it is an opt-out section, not an opt-in section. Okay. I'm not going through the anti-avoidance provisions, but there they are there for you if you want them. With detailed examples, you can go through them. All right. So, Section 43, you've got the examples there, but I'm not going to go through more detail than that because I do think there is not that important. Whereas Section 44 and the rest I do think are. So, Section 44 is you've got company A that owns land with 150, cost of 50. Company A sells the land to company B in exchange for company B shares. Company B then liquidates, and the sole shareholder of company A had bought the shares in 2003 for 60 Rand. So what are the consequences for a normal transaction? So if we did this transaction under normal rules, company A is disposed of land, so it's going to have a capital gain on the difference between the 150, which is the market value of the land, minus the 50 Rand base cost in the company, right? Gives me a gain of 100 and basically CGT of 22.4, right? Company B shares, the company B shares would have a base cost of 150 because that's effectively what I paid to get the company B shares. When company A then liquidates, it is disposing of an asset worth 150, being the company B shares to me. There will be no CGT on that. But because it's going up as a dividend, then there would be dividends withholding tax on that, dependent on who the shareholder is. Right, so they may or may not be payable. So the net result is there would be CGT on the sale of the land, and there'd be dividends tax on the distribution. For the shareholder of company A, they're going to get a dividend of 150 and have a disposal of the shares. So there will be a receipt of a dividend, a 60 Rand potential capital loss, and the base cost of the company B shares for them would be 150 Rand. Right. For company B, they will have the land will come in at a base cost of 150 because of the application of Section 40 Cap CA, and it would show CTC of 150. Okay. Right. So in what the amalgamation company is trying to do then is if you've got a resident company that disposes of all of its assets to another resident company and the disposal company is terminated, so you start off with something like that and you end up with something like that. So effectively where you've consolidated everything into one corporate structure, then what you can do in that case is that you, instead of disposing of it at market value, you dispose of the asset at cost, and the resultant company acquires it at cost. Right. So effectively what I do again is I scratch out the dividends tax consequences and the capital gains consequences. Right. For CTC purposes, you take whatever the shareholding of the amalgamated company is and go and add it into the new company. Right. So in terms of, if we then go and take that application, right, exact same example, what we do is, instead of reflecting the disposal of the land in company A at a value of 150, we reflect it at the original cost, which is 50. My company B shares then have a base cost of 50. I'd still have no CGT on determination, and there never will be dividends tax payable. So the end result of it is there's no CGT, there's no dividends withholding tax. All right. For the shareholder of company A, we're told to straight up ignore the dividend receipt. So we pretend we didn't get the dividend, and I'm deemed to have disposed of my shares for 60 Rand, which was my base cost that I held those shares at, and I acquire the company B shares at 60 Rand. Okay. So effectively, company A does everything at their respective values. The shareholder of company A does everything at their respective values. Okay, so this is also something which is quite important, because a lot of people misconstrue Section 44 and try and make the base cost of those company B shares now be 50 in the hands of company A. It's not. It's, you look at what the base cost, because effectively shareholder A is exchanging company A shares for company B shares. So we want to match the base costs of at the shareholder level. We don't look at what happened in the underlying company. Put it differently, we basically go and say shareholder A should be left with the same tax consequences pre and post the transaction, just instead of owning company A shares, they own company B shares, right? And company B will acquire, and this is the crazy part, and please don't sue me as the messenger here, is it will have a land at a base cost of 50, because that's what the land was acquired at, but it will have increased its CTC by 60 because that was the original CTC of company A. And now, Caryn, yes, you can tell me I don't balance.
And also, I mean, I don't ignore dividends. I'll take it at face value of what this transaction is. So if you tell me you're declaring dividends, I've got dividends. And dividend in specie has to be at fair value. So please remember that if it's exiting me, it has to exit me at fair value and arrive at fair value. So I'm going to look at this all at fair value. I'm going to look at this. I'm going to acknowledge the dividends that have been transferred with the assets to get them into the books, and it's going to all be at fair value. And then on a separate piece of paper, we've got these calculations. And when my carrying value and my tax base are different, I have deferred tax. And because it's day one transactions, that I cannot take it to my income statement, I'm going to have to take it to a reserve.
Yeah. Effectively, the idea, or conceptually, the simplest way I find to explain this is take the balance sheet of company A and you take the CTC and the asset across to company B. And for the shareholder, you just scratch out the name of the company and otherwise leave it as B. That's the end effect of Section 44, and then company A has to be liquidated.
But I'm going to look at the substance of the contract and the arrangement and account for it on face value.
Yeah. Okay. And you'll start to notice a theme as we go across. So I can go through these a little bit faster now. Oh, look, if you pay for the asset in consideration other than shares in the company or, a acquisition debt, then you have to prorate it. Okay, so I'm not going to go through that because the principle of the calculation is the same.
If you're reading these sections and you have a feeling of the matrix and deja vu, you are right. It is copy paste at sometimes with some of these sections, which is why we've spent a lot of time on the basics, so that we can move faster
Yeah.
through the sections.
So there's a worked example which shows you with the pro rata. As I said, it's the exact same principle, but I'm not going to, yeah. Also, anti-avoidance provision. Oh, look, if you dispose of it within 18 months, the section almost asks, well, why did you bother with the corporate rule transaction if you were just going to actually realize it anyway? So that's when that comes
And
up.
can we also just a little one just that we'll sometimes say to you is that sometimes if you have to come to Carmen and I with a transaction, sometimes we'll actually give you a shocking answer and go, just do the sale. Just do the sale. Because if there's a whole lot of issues around this, sometimes the simplest answer is to take it on the chin and just do the sale. Because you might be setting yourself up for heartache later, which is unnecessary because of what you're going to be doing later. So again, having the full idea, as much as these are really beautiful and lovely to use.
I think the main thing with Section 44 is that it really actually is simple, because if you go look at the criteria, it suits a merger in my mind beautifully, because a merger should be, a complete consolidation of two businesses. So you only want one entity to be standing at the end of it. So again, suited for purpose. It's not going to fit where you only want to take out a portion of a business. A Section 42 is then better suited for that purpose. Section 45 are intra-group transactions, right? As I said, this is effectively, as long as the key criteria for Section 45 is generally, are you part of the same group? Yes, no. Is if you're part of the same group, then you can move the assets between the group companies and nobody cares unless the payment is in the form of shares. And the main reason there is they're saying is that the concept there is, if you're paying for stuff in shares, you've already got Section 42, Section 44, and Section 46, which deal with Section 42 and Section 44, which deal with transactions where the payment is done in form of shares. So surely Section 42 or Section 44 is then better suited. And if it's paid for via dividends, we've got Section 46 and Section 47, which deal with where the payment is in the form of a dividend declaration. So then surely that's better suited for the purpose. So that's the only real restriction in Section 45, is that they'll try and channel you into the other sections if they're better suited to purpose, right? So realistically, if you take out issue of shares and dividends, you're really left with the payment is going to be in the form of debt. It's never actually specified like that in the section. The section just goes and says, do the transaction at cost, and doesn't even mention the other side of the transaction. So, which is why, to me, this is in a lot of respects, from a tax consequence point of view, the simplest of all of the provisions. If you're a group company and you're moving an asset from A to B, do it at cost. Literally scratch out the name at the top of the fixed asset register and move it into the new company and move on. Where you'll find the issues are in Section 45 is remembering the 6-year degrouping charge. And there are certain shorter period anti-avoidance provisions that apply where you change the nature of an asset. So if you have something which was trading stock, which becomes which was trading stock, which becomes capital, for example, you've got 18-month anti-avoidance provisions which apply there, but those are generally not going to come up that often. So the most important one really is actually the 6-year degrouping charge to remember. I don't know if there's anything else. This to me really is the simplest of them all. Happy to take questions on it. I will also concede it looks like the most complex of them all, because there's a truck ton of anti-avoidance provisions which have been put in because people play silly buggers with this section. But it's really not. Most of those, if you stick with the concept of don't do stuff for 18 months and remember the 6-year degrouping charge, you scope out of most of those anyway, and you don't even have to think about them. Okay. Any questions on Section 45?
I'll take that as no.
No. See, and I've got the details on the degrouping charge together with the worked examples. I've got the details on the anti-avoidance provisions. So you're welcome to go through those. Happy also to take questions on them. You don't want to apply Section 45. That's how you scope out. And sometimes you don't. Okay. Right. Section 46. This is our unbundling transactions. I think for me, to be brutally honest, Section 46 is the most complicated of the sections in terms of how you transact for them for tax purposes. The principle is really actually very simple, but the numbers can become horrible. I'm saying that in the nicest possible way. And the idea with Section 46 is really to try and create flat structures. Right. The reason it becomes complex is because of the fact that we now have to look through the companies and try and apportion base costs and CTCs between companies, which now become sister companies, which were previously subsidiaries and holdcos. Right. So under normal rules, if you've got a holdco that owns 80% of subco, which in turn owns 100% of super subco, and subco distributes its shareholding in super subco to holdco, what would we do? So subco would have a disposal of its investment, so it would get a capital gain, right? Because it is got a asset with a market value of 250 rand, which it's disposing of. So CGT on 150. Dividends withholding tax. So it's a dividend in specie. In this case, though, it's company to company, local company to local company. So it's exempt, not relevant, but there is CGT. For holdco, they are receiving a dividend of, apologies, that should be 250, not 200, which should be exempt. And basically, that's it. And then the base cost becomes the 250. Okay. And for super subco, well, that's a shareholder change. All I have to do is go and make the share register work. It's literally all that happens.
For me, the reason I like 46 is it's a dividend distribution. So I'm just needing to do dividends resolution, directors resolutions, shareholder resolutions, and declare a dividend. It's in specie, so it has to be all done at fair value. So I might have to do some fair value adjustments because my accounting policy might have been a cost. But so I might need to just fair value it, which isn't my normal accounting practice for it, because it needs to exit at fair value and land at fair value. But my administration, in terms of, I don't need sale agreements and transfer agreements and all of that. I just have to trigger a dividend. I might have to change, if I'm doing property or whatever is my dividend in specie, I'd have to change things. But for investments and all the rest, life is a little bit, and loans and things like that. I like 46.
Yeah.
But I don't deal with your side of it. I deal with the face value side of it.
Yeah. So what are our T's and C's? In order for Section 46 to apply, you need a resident company that owns shares in another company. If it's a listed company, you must own at least 25%. If it's unlisted, you must own at least 50%. So this is at the subco to super subco level. I need my subco to own at least 50% of super subco. And I must give my super subco investment to my shareholder. And the trick there then is the person receiving the dividend must be a group company, or the person I'm distributing to, it's a listed share, or I'm doing it because the Competition Commission told me so. Right. So for most of our scenarios is we are looking at the dividend declaration must be going. So if I look at my 3 levels effectively, my unbundling company must be a group company with the holdco, and the company underneath must be at least 50% owned by the unbundling company. Right, so this must be group, this must be 50%. Right. So if I go back to this example then and go and say, well, how does this work out? Company A owns 100% of Company B and distributes all of its shares in Company B to its shareholders. Can I use either of these? If Company A is owned by many different parties, can I use Section 46?
Am I allowed to answer or do I have to keep quiet?
Go for it.
Well, the first one I'm happy with.
Mm-hmm. That one's
because
100%.
Yeah, because 80% makes me a group. I have more than 50% of my super subco, therefore that's fine. Company A owns 100% of Company B and distributes all of its shares in Company B to its shareholders. Now, there I have a problem because that's not a group.
100%. So the problem isn't at the Company A to Company B level. So Company A and Company B at the time of the distribution are a group. But my group test isn't happening at that level. It has to happen at the Company A to its shareholders level. And because it's owned by many different parties, I'm probably not meeting my 70% criteria. So no, I can't do it. If it's owned by a trust,
not a group of companies.
Still not a group of companies, even though it's 100%. So therefore, I wouldn't be able to do it either. But scenario 3, I could, because it's one of my specifically listed criteria, is if the Competition Commission tells you so, you do so. And then Section 46 can apply. All right. I'm not going to go through the foreign ones at all. So effectively, other things just from a terminology, the way the law works, they refer to this as the unbundling company, and that is the unbundled company. So in other words, the one that's being moved up to the holdco, and this is the one that's doing the work, as it were. There's a few bits and pieces of when it doesn't apply. Right. So that's the how I scope in. The consequences can become messy. And I'm going to be the first person to admit that this isn't always the easiest thing to understand. Conceptually, what SARS is again, or what the policy is again trying to achieve, is they're trying to say, pretend that instead of having bought the investment in Subco, and Subco having then done the investment in Super Subco, let's get me into the position I would be in if from day one, Holdco had actually done the investment directly into the unbundled company. Which is why you'll see that the transaction is basically saying, ignore the disposal, ignore the dividends. But when it comes to doing the valuations on the books, what the you are going to the unbundling company is going to ignore the CGT on the disposal of the investment in the super subco, but it's going to have a reduction in its contributed tax capital, because the theory is that I only received a larger investment from our holdco because I was taking that money to invest in the subsidiary. From the holdco's point of view, they have to split their investment in subco now between the investment in the unbundled and the unbundling company. All right. So effectively, for tax purposes, the unbundling company disregards the distribution. You disregard the dividends tax, but I adjust the CTC. Right. Let's look at a worked example. So we're doing this all at 100% to make this as simple as possible. Right. So what the Section 46 is basically going to go and say is that if Company X owns 100% of Company A and Company A owns 100% of Company B, Company A has no disposal for CGT purposes, and my CGT is reduced. It becomes a percentage of market value after disposal to market value pre-disposal. So I'm going to have to reduce my CTC in company A. Company B has to change its CTC. They get that portion of CTC that company A has to reduce, effectively goes into company B conceptually, because we're saying that should actually have been a direct investment from Holdco into company B. So I get an increase in CTC in company B, and company X has to split its base cost between company A and company B. So as I say, from a tax point of view, this is the most complex.
I've just remembered that I don't deal with the side, I deal with the other side. Yeah.
So this is also where I'm going to say, conceptually remember this. Because of the timing, and we're going to leave the accounting, I have given you a worked example. There is full details and examples in there. But the main idea is conceptually, the argument is that the CTC of the two underlying companies needs to be adjusted because company A is overstated because it's got its investment plus Holdco's portion of what it wanted to invest in company B. So company B is also understated because it needs to get that portion by which company A needs to be reduced goes to company B, and the base cost from the Holdco point of view needs to be split between the two companies. Right. But from an actual CGT payable or a dividends tax payable point of view, we do everything at original cost. Right. So there is, well, actually, I just ignore it. It tells you to ignore the disposal and to ignore the dividend and to make these three changes instead. Right. The last one is the easy one, and then Caryn, I'm leaving you not that much time, is section 47.
I just need to get some core concepts across, and other than that, I'm happy because
I think we've also discussed a lot of them in between.
Yeah, as we've gone through. And just for the audience, we took a sort of executive decision in the breaks to sort of say the tax was, I think, what people really needed to see. My side of it is the sweep up and clean up. Anyway.
I'm leaving on a happy note, though. Section 47 is the easiest. It's basically, do all disposals at cost, ignore the dividend. Basically, lift the TB of the liquidating company, slot it into the Holdco. That's it. We're done for tax purposes. Okay. It is as simple as that. It really is. So if we go and look at the example.
One thing, though, we've did just from a practicality and a compliance point of view, Section 47 allows you to deregister as part of liquidation as well. So a lot of people go, oh, liquidation is so hard, takes so long, it's going to be forever. But deregistration is actually quite straightforward. So if you've got an empty balance sheet, to deregister is simply a resolution notifying SIPC and going through some very simple steps to get it done. And that qualifies for Section 47 as well. So it's not just... Yeah.
Okay. Caryn, do you want to take over the screen share?
Okay, so let me just figure this out because we're doing things a little bit differently today because of the tech issues that we had earlier. So I just have to give myself permission to screen share. And if everybody can just hold on for 2 seconds. Am I there?
Yes, I'm getting the circly thing, but yeah, there you go.
Okay. So for me, the theory of what we're doing is business combinations. So I'm going to head to business combinations and say, okay, I need to unpack everything you're doing here in terms of business combinations because you are really bringing businesses together, changing businesses, disposing of businesses or something like that. So for me, it's all about control. And as we've already mentioned, control for accounting tax, we look at it slightly different. I'm not going to ask this question now because it's actually one of your assessment questions. But just to note that the reason, the trick with business combinations is that it's also the only time you can recognize goodwill. So if you're going to want to bring goodwill either to the consolidated financials or into your primary set of financials, you have to acquire a business whether it's the shares of the business or the operations of the business. Shares of the business means the goodwill will sit in the consolidation. The operations of the business means that it will sit on the primary financial statements. But I need two things. I need you to acquire a business, and I need you to get control of that business. Okay. So if you're going through those questions, think about those 2 points. And then we've already discussed whether or not something is a group or not, so I'll leave that for you to think about. The core ideas that I'm also wanting you to think about is when you bring everything in, it's always at fair value. Okay, so whatever Carmen's just sent me in the contract, I need to look at the fair value of the assets I'm getting. I need to look at what liabilities I'm assuming. I might need to look at contingent liabilities because those have now become actual liabilities to me. I might need to look at what you couldn't recognize as intangible assets, but I can because I'm buying them. Things I can't recognize, for example, is a restructuring provision that I want to instigate. So I can only bring a restructuring provision in if you've already got it on the books. Okay. And when I put all of this together and say, okay, this is the bag I'm getting, which makes a business, and this is what I'm giving up for it, be it shares or be it whatever, the difference between that's going to be goodwill. Okay. And so the key to it is that, okay, that I want you to get. There are all sorts of different ways to do it. A lot of this ties back to the buying and selling of a business that we did last year. In these ideas as well, with these restructurings, who is the acquirer? Who's getting control of what? Because you're moving things around the chessboard, you're restacking the deck chairs. What direction are these transactions actually going? That is one of the things that I find often to be quite interesting. I will just leave you with an idea here that, and it's going to be something coming into IFRS for SMEs, but the idea of control in IFRS 10 is very different to where we are at the moment. And we actually have a 6-step process to define it. So that is why I could have a 30% holding and have control and have a group, which of course the Companies Act and tax would laugh me out the room. But I can actually do it. Okay, so you've got to be very aware of it. Carmen uses the word amalgamations. I go, what the hell is that? I do not believe in mergers. The word merger and amalgamation to me is a psychological idea because at some point somebody's always going to be the stronger party. So the stronger party is the one that is the acquirer. I need an acquirer. Okay, I believe in purchase accounting all the way. A question, Carmen, I had one of our really good clients recently. We had a half-an-hour discussion looking at a contract about this. What is the date? Because for business combinations and for me to trigger the accounting, I need to have the moment I have control. That moment I have control is my acquisition. My acquisition date. I can make payments. That doesn't change things. I can exchange things. That doesn't change things until I have control over things. When I have control over things, that's my recording date. So when I can say to you, jump, and you say, how high? That's the date that is most important to me. And we've got to interrogate the contracts to get to this point. So one of the things that often creates problems here is suspensive conditions. Suspensive conditions to me are, it depends, because some suspensive conditions are just sorting out the fine print, maybe finalizing the purchase price or the amount that this is going to be settled at. But sometimes the suspensive conditions actually determine whether or not you have control. So the acquisition date is going to be the date that we have control, and whatever that means in the contract. And sometimes the contract will say, on this date, you can move in and you can start bossing us around. It doesn't matter that the title deeds have passed or not. It doesn't matter that the fine print hasn't been finished. It's when I can walk in and say, jump, and you say, how high? Okay.
Yeah,
and Carmen and I find often that's a problem in some of these agreements.
A, because it's not clear, but B, also it does mean that dependent on the nature of the transaction, you may actually have potentially different dates. So you also need to look very carefully at the dates, because my key point for recognizing the Section 42 is the day on which the transaction is concluded. So effectively on the day that I do the swap, I need to have the qualifying interest.
So you would want for that, you'd say the date that it's concluded, which means if there's suspensive transactions or anything around that, that would all have to be sorted out.
Yes.
For me, the date the asset came into my grubby little paws, and I can start using it and start, doing whatever I want with it, and I control the asset, is the date of acquisition. So values could also be different then, by the way, because fair values are date specific.
Yeah. Section 45 is probably the one where we're going to have the potential biggest disconnect, because I know Section 45 tells us to override the normal principles, but it would still, and ideally this shouldn't make a difference, but yeah, well,
it does.
It does, is your date of disposal is effectively the date on which you effectively relinquish. I would go and say is that you actually go and have it would be the effective date of the transaction. It's the date on which the transaction is again concluded. And that's when I'd be recognizing the tax issue, or when I start counting on. Now, for a Section 45, if it's a true Section 45, it's not going to make any real practical difference because I ignore the tax consequences. But if you're starting to count your 6 years for your degrouping charge, then it might start making a difference. So just please be careful of dates as well, and they could be different.
Yeah, so for me, it's the date I get control. That's my acquisition date. That's the date that I move things around. It's my golden door date. It's the date that things are magically changing between parties. And for me, in IFRS for SMEs, IFRS and every other thing, it's when I get control, and it doesn't have to be the legality of that control. It has to be when I can start bossing people around. Is the way I like to think of it. Okay. The other thing that may or may not work for us is, are there any acquisition-related costs? The lawyer's fees, the valuation fees, the conveyances fees. Now, in IFRS for SMEs, we have to capitalize for the moment. It's changing. In IFRS, we expense these. Okay, and I'm not too sure if there's any, so when we're looking at the values and we're looking at what we are actually paying, just remember that I cannot capitalize acquisition-related costs or a full IFRS client, but I can for an IFRS for SMEs client as it currently stands. So these values are going to have to be looked at quite closely. Okay. In the notes as well, I go through, the restructuring costs are often a problem. I go through a whole lot of ideas about what we do and what we don't do, but the golden rule is always fair value at the date of acquisition. So whatever you're bringing me, I'm going to bring it into my books at fair value at the date of acquisition. And a lot of the rest of the notes that I've got here are really helping you work out what those potential fair values could be. Okay, so if you're going to get seasick, please close your eyes right now. And if I had time, I would talk about reacquired rights and indemnified assets and things like that. If we've got minorities, we've got to take care of them. And as I said before, we've got this thing called goodwill, which I actually heard the tax does sometimes recognize or acknowledge.
Purchased.
But yeah, we speak to that more in last week's or the last session with buying and selling of businesses. So I've also got an issue if you're settling in shares. I want to know, are you using them as a currency, or are you using them as equity? Because that's obviously going to be an issue with valuations. And then these contingent considerations, these suspensive conditions, otherwise known, can cause issues. The one grace that we get in all of this is that accounting acknowledges that this stuff takes time to settle down and to sort out and to finalize. And we have a measurement period, an initial accounting period of 1 year from the transaction. So you do the best you can at the reporting date. And if you still don't have all your ducks in a row, you don't have all the detail yet, you will assess it on probability and on estimates. And within 12 months of the transaction, you can go back and fine tune and adjust without admitting an error. This is an initial accounting period, and then after that 1 year is up, then you got it wrong and now it's an error. So don't get too stressed if the data isn't coming in and the numbers aren't coming in. Maybe you've got a suspensive condition or two that's causing issues. You have a year to tidy it up. After that year, it becomes an error. Okay. And then, you see, I can do this and still leave a few minutes, Carmen. Section 42s, just as because we deal with these all the time. Day one, okay. First off, does your MRI have sufficient, because you've got to do a fresh issue of shares. Okay. So do you have enough authorized share capital to do the fresh issue? If you don't, before you even start this transaction, you're going to have to amend your MRI to increase the authorized share capital, or maybe you're going to have to do a share buyback or something so that you have authorized but unissued shares in order to start this transaction. You can't backdate that. Okay, so that is something that you can't backdate. You can't suddenly wake up and say, look, I really want to do this on the 1st of March and I'm sitting in July. You're only going to be able to get that transaction sorted out now. Okay. Secondly, what is the value that we are issuing it at? It's at fair value. Okay. The value of the assets at fair value, which is where Carmen is saying now our contributed to tax capital is going to be different. The value of the asset compared to the tax base is different. And we do have deferred tax that is flowing, because the whole point of doing these transactions is to defer the tax consequence to a later date, for the group not to deal with it, but for us to deal with it when this transaction hits a third party. So we've got to make sure, and the other complication sometimes is where the deferred tax is sitting. It's been moved into the company that has, you've taken it from the one company and put the problem into the other company. That company, when it gets realized, is going to have a tax consequence that initially was the previous company's problem. Okay, so this deferred tax is just showing the users and showing the shareholders that you're not out of jail yet. You're not scot-free yet. You've got to keep a little bit of cash aside to get all of this sorted out as and when you need to get it sorted out. We've already mentioned, I want you to disclose this event in full. I want you to disclose it in your stated capital part. I want you to disclose it as part of the business combination element, if that's the way it's landing. Because you need to show people that you've had this asset, that this is the way the asset came into the business. This is the way the asset was financed through shares. This is the fact that you've got this deferred tax as a result of a Section 42. That's why it sits there. And then bear in mind that at the end of this, often somewhere along the line, someone's getting liquidated and distributed. What are you distributing? Okay, what are you disposing of? So again, that right of return of equity. Are you disposing of the asset? Are you disposing of the investment? Are you disposing of the shares? You need to be very, very aware of exactly what you're doing, because Carmen, that's something else we've come to see often is, we had a situation with a property holding group where they created the holding company because they were holding it in trust. And then they had hundreds of companies. Every property they had was in a separate company. And they basically did these asset for share swaps to get the properties into the company. And then they left with all these shell companies afterwards, which they then wanted to shut down with the liquidation dividend. They needed to know what they were distributing. They needed to know what they were actually cleaning out. And the consequences of that. So I know I've just gone like a whirlwind through this. But, a lot of my work was done in the buying and selling of businesses. And I just wanted to reiterate some of the key points when people come to this. But the first thing that I'm going to be saying to you when I walk through this is, what are your fair values? And what is your date of acquisition? And what is the actual face value of the transaction according to the contract? If I didn't know anything about the Section 42s or 46s or anything else, I'm going to read this agreement, this resolution, this decision, and account for it as it looks on the top. And then I'm going to acknowledge that my tax numbers are going to be different to my carrying amounts. And that is why this really and truly is the purest deferred tax section that we can have. You see, I'm an octopus. You give me 15 minutes, I can fill 15 minutes. You give me an hour, I could fill an hour. But yeah, I just really want to get those key points across so that you just also acknowledge that when you're dealing with the tax element of it, think of Carmen, hear her voice, and then you've got to switch gears, switch faces, and then remember that you've got the accounting face and the compliance issues to track at the same time with these. And you need to put today's session together with our previous session. It's sort of, they work as a bit of a mini series in all of this.
And I think across the board, there's a lot of this which feels daunting, and I will fully acknowledge that. But they really are, once we can go with the idea that accounting will always go and say market value, tax might have special rules, and we can recognize that those two rules work independently, I think it makes the rest of it a lot easier.
Yeah. Now, and that's what we've come into to realize. So often we'll get called in for a consult. I do exactly what I've done today. I sit back and listen. I sit back and listen to the objective and the aim of what they're trying to achieve and what they want the balance sheet and all the rest to look like at the end. And then I listen to Carmen give them the toolbox and say, okay, are we using a hammer, or are we using a saw, or are we using a glue gun to build this new version of the business? And then I take it chronologically and step by step and say, okay, well, you've done these transactions, and then this is how we're going to account for it. And the values per tax to the values per accounting are going to create deferred tax. And that is how we're going to, that's the bridge between the two, is an acknowledgement that that there is a tax consequence that is different between the two of us.
Yeah. And I think possibly just the last piece of advice that I would give in this one is having a proper understanding of the nature of the transaction that you're entering into is I've said it before and I'll say it again, is probably the most important part of this, because if your planning is right, then getting the accounting and the tax right is easy. It really is. If you don't understand the objective, it goes wrong. But also, where we've seen agreements go wrong is people trying to do, for example, a Section 46, which is structured by doing dividends. It's very clearly in the section, I need to declare dividends, and that's how I move my shares up. But the agreements talk about a sale with loan agreements. That's not what we try to achieve. So that is also something why the planning is so important.
The other one that we see often is that they sell the share at this value, but then the loan account gets left behind. And we're going, but what was the value of the share then? Did the value of the share include the net value of the company? Or where did the loan get cut out here? So how is it that you're moving the share across and then the loan separately? So it's not clear in the agreements. There's no clear idea to what they're trying to do. So it's almost like step one. This is what we are wanting to do. We're wanting to get this ownership here. We're wanting to flatten the group. We're wanting to move these loan accounts here or there or whatever it is. Now, what matches in terms of the most efficient way in tax to achieve this? And then the accountant goes, okay, now give it all to me and I'll put the debits and credits together. I don't know if you agree with that, Carmen, but that's the way I see it.
Very much agreed. Right, we are 3 minutes over time, so I haven't seen any other questions come through. Caryn, have you?
I think they're shock and awe. I think they're like deers in the headlights at the moment. If you've got particular clients and you're needing to consult with us on an individual basis, with that client, obviously that'll be a consultation. This is a specialized area and it's a big area. It takes time to sort this all out. Carmen and I are available for consultation on those type of things. They're generally not quick question answers because we have to get an understanding of the bigger picture. But we do that kind of work for a lot of our clients. But we're hoping that we've at least given you the resources and we've given you a lot to reflect and chew on. And more than likely, you need to go and have a glass of wine with your lunch right now, just to sort of let it all settle in your minds. But we hope that we've at least opened the topic to you and given you some thought. If there aren't any questions, we're going to wish you well. I hope that you have a good Thursday, and it's Friday Eve in my books. So this is the way that we work things out. There's quite a bit of work that I know I'll be around quite a bit, I think, next week for everyone. And Carmen and I will be back next month with a non-profit session, another session that's very muddied and confusing, and people have got old habits with new laws. So we will be addressing that one next month. But otherwise, good luck. Those of you that are doing restructuring, I hope we've given you some food for thought and some solutions to your problems, and not problems to your solutions. And we'll see you soon.
No, absolutely. Thanks, everyone. Cheers. Bye.
Bye.